What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hi everyone, welcome back to What's Making Headlines, your weekly rundown of the big themes that we've been writing about in the mortgages space. This week we're doing things a little bit differently in that we are joined by two guests from other titles that you may already know in the Momentum Media suite. Phil Tarrant, the head of content here at Momentum Media, who's also very active in SPI in the property investment space, and my colleague Liam Garman from the real estate business and real estate agency titles, real estate business over there as well. So a lot of stuff that we could be talking about because the main focus at the moment has been macroprudential risk, what's happening with mortgage demand, investor lending, will there be new curbs coming in, plus what is the issue with buyers agents? And we'll get into that today. Thanks for joining me, gents. Things are hot at the moment.
Things are certainly hot at the moment. What are brokers saying around the caps on removing of the 5% deposit scheme? There's a lot of stuff coming downstream.
Yeah, so I think brokers have been the core channel actually for the previously known as the home guarantee scheme, now called the 5% deposit scheme, for the last few years, and then it expanded on the 1st of October, as everyone will probably know. And when it was coming up, everyone was like, all of our clients are reaching out to us, they all know about it, they're super excited, they want to get onto market. Loads of brokers been super busy with those. The main issue they're having at the moment though, of course, is because there's so much demand, the lenders aren't able to keep up. So the wait times now for these loans are really blowing out. So it used to be that I think in August, September, it took about 3 or 4 business days for a loan to get pre-approved, or in some cases, like just to initial credit decision. Now it's taking up to 2 weeks, 3 weeks. So lots of lenders really struggling. We actually did see a few lenders as well say they're going to stop pre-approvals altogether for a moment just because they can't keep up with the demand. So, there's always going to be this issue when you have a huge demand driver that, yes, that's great in theory, but you haven't got everything in place to actually keep up with that demand. Yeah. So there's definitely delays going on, which, as we know at the moment in this property market in spring selling season, not great to have to wait 3 weeks before you know whether or not you can actually go to an auction and start bidding.
Yeah, and I said it when this scheme was expanded, that it's probably going to be one of the most idiotic policy decisions made by this government, which is going to negatively influence property markets. Now, you've got access now for the majority of Australians to buying property, taking on a 95% loan at the maximum amount. And let's be clear, most Australians will buy the most expensive house they can afford based on their serviceability, so they're taking on big debt. So look, if you're in early into the market, maybe you get the advantages of buying a property and getting uplifting in values. We saw the Treasury modelling come out when this scheme was introduced, saying that it's going to be a tiny fraction of upwards pressure on prices as a result of this over a 6-year period. I think the numbers are very, very clear now that it's accelerating price growth rapidly. It's like throwing, fuel into the fire, and already property markets getting misaligned. Now, running in parallel with this, and this was some of the numbers I saw from Eliza's piece, Annie, lending rates now for investors is up to nearly 41% nationally of all percentage of all loans.
Record high.
Yeah, absolutely. In New South Wales, it's 46.7%. So nearly half of all loans originated in New South Wales is for investors. And then first home lending is on the rise as well. That's sitting nationally now at 21%, and that's going to continue to climb. So you've got a lot of upwards pressure on prices at the moment, and all that's happening is it's driving rapid increases.
Yeah.
And a lot of lenders are concerned and worried about it. And we see this now with APRA now saying, well, we're not happy with this high debt-to-income ratios and also rapid investor lending.
Well, actually, all of those things that APRA is currently looking at, so the deposit scheme they're looking at, as you said, 95% deposit, that could put a lot of people into some pressure. 95% loan, that could put a lot of people into pressure with servicing, with actually having to keep those repayments. They're looking at that very closely and being like, how will that impact the financial stability of Australia? They are looking at investors as well. If you recall, back in 2017, they brought in limits for lenders to curb investor lending to 30% a year. So 30% of new lending was the cap that they could do for investors. And as you say, they were over that by quite substantially at the moment. So there's a lot of chat. They have been talking to lenders about what curbs they would bring in to reduce risk in these spaces. So whether that's debt to income ratios, so saying you can only take on a certain amount of debt if you've got a certain ratio, or curbing the proportion of new lending they can write for investor. Like, these are all things they're looking at. They did an update last week, actually, looking at their outlook. And this was something they had chatted about, saying we've been talking to lenders already. We're testing what the feasibility will be for bringing in curbs.
And you're already seeing some lenders regulating themselves, with Macquarie Bank coming out saying no more new lending in trusts and companies. And CBA followed suit, albeit more diluted, saying they won't do that for new customers, I believe. Is that correct?
Yeah, so you have to have a CBA account with them. Those are interesting. So this is lending in trust, or if you're a company. And I think this is largely due to concerns that people are trying to circumnavigate lending laws that APRA puts in place and that ASIC puts in place, to ensure that people are borrowing the right way and they're not putting themselves into stress, and they're not trying to, reduce their serviceability, for example, by suggesting that they're doing something they're not. So they just want to make sure that everything is tight and up to scratch. And I think so for Macquarie particularly, they were saying, really seeing a lot of finfluencers or spruikers or unregulated non-financial advisors, non-brokers, suggesting that people start purchasing through an SMSF, suggesting they start up an SMSF to do this when they're not qualified to give that advice, and in some circumstances giving quite bad advice. So Macquarie was saying, we're not going to do that. I think they might still lend SMSF if you just are or an existing client, for example. And I think if you can probably show that you're just one, I think it's the multiple ones they have issues with.
So the City Committee and maybe, having a crack at this unlicensed, unregulated advice, a lot of it propagated by buyers agents, is a handy or useful excuse to curb that type of lending. If it's rich pickings over on the first home buyer land, and that it's going to be a big fat loan at 95% LVR that's guaranteed by the government, obviously, there's not an endless amount of money inside the banks and they have capital controls around it. You think they're going, well, we're going to back one horse right now, a contrarian view, but we're going to back one horse right now. Well, let's do first home buyers because we know our money's guaranteed, and it's just a useful excuse to be blaming property spruikers to pull out of investment loans.
Yeah. Macquarie's known for it. They've really shrunk what they like to lend in. They're kind of known as the professionals and the mum and dads. They're very much vanilla. If you've got a sort of straightforward loan, Macquarie will do it. They're the fifth largest bank now. They've grown 40% in the last year alone. They are absolutely smashing the lights out, and brokers love them because they're super fast. So we're seeing a huge amount of growth there. But maybe it is if they're looking at tightening up just to really focus on their core kind of prime market, as if it were, then maybe that is a move for that. But I think it's more about reducing their actual financial risk.
Well, and sorry, Liam, I've got a question for you, but I want to finish with Annie. PICA, who is the Property Investment Council Australia, which is there to support property investors, were very vocal in championing this idea around curbing lending in trust. And it just seems as though it's got out of control. One or two people have jumped on this idea that, inverted commas, it's a way to navigate around serviceability requirements, and you can have an endless building of your property portfolio by moving around from trust to trust, and trust protective. All you need is an accountant to write a letter to say your trust is positively geared. And I know there's certain people in the accounting profession who are very concerned and wary about it because it really goes to the professional ethics of accountants that they're signing this stuff off. The reality is that if you're borrowing in a trust at 80 or 90% loan, you're not going to have a positively geared property there for quite some time. So it's fishy. It's certainly fishy, and it needs to be regulated. And PICA was championing for it rather than pushing against it.
Yeah, Ben actually wrote an opinion piece for us, which I think ran across all of our titles, talking about this. And lots of brokers have talked to me about their concerns with unlicensed financial advice coming through from the buyer's agency realm particularly, and saying these guys need to be regulated because they're suggesting that people do things like set up an SMSF, which they're not allowed to do. They're referring them to accountants or financial planners or brokers to try and get an SMSF loan.
And I, just did a little experiment yesterday where I sat on my Instagram and I spent 15 minutes scrolling through my feed, and I collected 60 different buyer's agents popped into my feed telling me all the reasons why you should be investing in property in hotspots and all these great, whimsical, wonderful ways you can go about doing it. It's prolific at the moment, and I've been very vocal and considered in my positioning on this is a formative period for the buyer's agent as a profession. And I saw the growth of mortgages, and it went through a bit of a wobble there probably 20 years ago as it was finding its feet and probably trying to understand itself. Buyer's agency is certainly in that mode right now, and it's either going to swing two ways. It's either going to become and sustain itself as a very professional, organised, coordinated group of people who are providing true advice and insights into building property investment portfolios, or is going to go the other way and just turn into a
Well, I think that's the problem. They shouldn't be providing advice. They should just be finding property.
Yeah. Advice around what property you should be buying is the point.
Yeah.
Much like a mortgage broker can provide debt advice, but a buyer's agent should not be providing advice on financial structure and all that sort of stuff. So this is where we're at, Liam. But when you look at supply and demand and a lot of all of this stuff that's happening, it's putting big pressure on the supply side. And I saw only yesterday SQM come out with their regular report where they had their sort of four scenarios, what it looks like. They're saying, you know, Perth to grow 16%, depending on some base scenarios next year. Sydney and Melbourne to be subdued. But a lot of this is going to be driven by how much energy and how much momentum is in the system, which is going to get compounded even further. Now, talking about supply and demand, running in parallel with this, you want to put more fuel into the fire. The government's about to write off 20% of everyone's HEX debt.
I should have known you were going to mention that. Should have known.
But you think about it, is how? So the question is, how much is that going to accelerate people's buying decisions now if they're a first-time buyer? If they're pretty much, maybe, I don't know the numbers, but, you know, I think it's worth $16 billion or something or other, right? The whole amount is getting written off. There are going to be more people in the market sooner and earlier as a result of it, or subscribing into an uncapped 5% deposit scheme backed by the federal government.
There's a few areas that concern me with the policy, and obviously I think it was 5,500 people in the month of October took up the guarantee, so it was quite well subscribed. The thing that concerns me about it is that there is a bit of a myth, because every state's stamp duty laws are different and stamp duty exemptions are different, that you have states like Queensland that are very forgiving and states like New South Wales which still have tighter stamp duty exemptions. So I very much see, to your point earlier, where we would hazard a guess, it's behavioural, it's cognitive finance, that people would be borrowing up to their absolute maximum, that if you are borrowing up to that 1.5 million, which you can in, or house up to 1.5 million, which you can in New South Wales, you're still paying quite a lot in stamp duty. One thing that concerns me is that I think you're going to have a whole generation of people that are going to be in negative equity. You're going to be in asset classes, units, smaller apartments, beginner asset classes, which won't likely grow as quickly as houses. Now, there will be some areas, you've highlighted before, you know, there's always going to be some element of hotspots. There's always going to be postcodes that grow quicker than others. But in this lower quartile, it is likely that people are going to be in asset classes that don't grow as quickly. So when you have the transaction costs coming in and the transaction costs coming out, when you have agents charging 2.5% of commission fees and selling fees, and then you have all the other fees that
Buyer's agency fees,
all the fees that compile on it, you're going to have a whole generation of people here that are in negative equity. So that concerns me to the one part. The buyer's agent point, though, that you raised is very interesting, because I see it as well. Every time I'm on Instagram, and you get people that are so openly flaunting rules about financial advice. You'll have an ad there, and someone will be going through on the ad about how you can just leverage up to your eyeballs and what hotspots you're going to be that you should be looking at. And I think it's very fair to say for a lot of our listeners that beware the Instagram ads, because if your buyer's agent's spruiking a particular hotspot on Instagram, there might already be some vested interests in that hotspot, because if they're a first mover, they're not going to want everyone to know about their first move, right? So looking at that as well, the supply demand aspect that you mentioned, Phil, before, it's not going to get any better. You've seen that with a lot of windfall from stamp duty that a lot of state governments are having. You've got state governments that are increasing their infrastructure spend by tens of billions of dollars. Obviously, we're in Sydney, we have the metro, we have new highways, you have the Olympics in southeast Queensland. You have a bit of a turn down in mining revenue. So what they're doing in WA is they're increasing infrastructure spend for what is an excess of labour supply in their trades to ameliorate the risk of economic contagion from a shutdown in the mines. So I think the projection of infrastructure spend in WA is going to be about $30 billion itself. You've got this very constrained pool of trades workforce right across Australia. And what's going to be happening is you're going to have very well remunerated jobs working for state government or state government contractors, which are going to be in direct competition with the housing supply market. We already have record high levels of migration. Migration on the one hand, you also have now, we're projecting up to 1 million foreign students in addition to. So we're saying that what's that, 4%? 4% of our population are going to be foreign students. The supply demand is not loosening to a point that I necessarily see a glut of new houses coming or a reduction in supply. Yes, we've got to be aware of these charlatans that we were talking about before in buyer's agents, but I still think the economic data is clear that there are going to be a lot of areas across Australia that are going to have double-digit house price growth over the next 12 months.
Yeah. And sorry, just quickly, we saw the recent monthly inflation data. So the ABS now has changed the way that it tracks inflation. It's now doing it monthly.
Yesterday was
Today.
inflation. Today's coming out,
And it went up 3.8%. And housing, the lead contributor of it, up, I think it's almost 6% over the year. So annual inflation for housing up 6%, and most of that because of construction costs, because you can't find a tradie for love or money.
And that's exactly what it is. When you've got construction costs flying so much, I think the cost of materials alone is up 40-50% since the start of COVID. Yeah. So what was that 10 years ago? I mean, there's going to come a point where that lower quartile house price is going to have to converge and grow to a point where if your average new building construction cost is $800,000, I think you're going to see a lot of those outer metro and a lot of those regional areas. They're going to boom. They're going to boom in response because you're going to have some level of coalescence between the cost of building a new house and the average house price. So I, to our point about investor lending, I think it's going to continue to grow.
Yeah, unless APRA steps in and curbs it.
Yes.
Yeah, and so you sort of touched on it very briefly, Annie. Like, you just think they'll apply speed breaks to
just based on what they've done before. So in 2017, they brought in, I think it was a 10% limit, an annual limit on interest only, and then a 30% new lending limit. So they couldn't go over that. So, yeah. But
it's just not going to be targeted at, and this is the irony of it all, right? Because they're going to be taking a look at debt to income ratios, right? As part of this, from what I understand, APRA as well as investment lending and interest only. But debt to income ratios, if you're using the 5% scheme, you're inherently going to have a high debt to income ratio. So isn't it counterintuitive, the fact that the government is saying, hey, let's get more Australians into houses, but by inherently doing that, they're creating loans with higher debt to income ratios. It doesn't stack up or make sense.
And we still have yet to see the Help to Buy scheme, which we have been promised this year. It's almost December and we still haven't seen it. This is the shared equity scheme where the government will buy 40%. So that even more will fuel demand further. But also, I mean, that will potentially see maybe less demand for the first time guarantee scheme. If people are like, I can buy property with government, they'll own up to 40% of this property and I don't have to worry about it until I'm selling this property. That might ease some demand, but it's still, from the guarantee scheme, it'll still be feeding into people wanting to buy.
To Liam's point on that, as an Australian taxpayer, I don't want to be funding. I don't want to be investing in property as a
secure asset
at a taxpayer when people find themselves in negative equity just because of all the things that Liam spoke about. To me, that doesn't pass the pub test.
No, and I think it puts Australia in a very dangerous economic position with APRA. Now, I don't. You and I do this on a lot of podcasts where I get my kind of your tinfoil hat out.
Here we go.
But is there a risk given, and this is something that you and I have unpacked actually quite a lot in terms of the hotspots, right? And what's a genuine hotspot because there is so much economic growth or so much population growth? What's that versus an investor-led hotspot? And there are plenty of places where you can look at it and say, well, the underlying financials of the area don't lead to it being a real hotspot. It's an investor-led hotspot where you just have billions of dollars of investor money driving up a market. Is there, given the windfall that state governments and the feds are getting from investor spending, I don't know, is there perhaps the feds behind the scenes saying, well, no, we can't rock the boat because isn't stamp duty our second biggest driver of tax revenue?
APRA and the government will butt heads a lot, and a lot of the time because of things like this. Like, you often see Jim Chalmers, the treasurer, saying, "I am advising APRA we are going to do this," or "I'm telling APRA we're going to do this." They are completely different. They are not politically aligned, and they shouldn't be. The financial stability of a country shouldn't be a political football. But I think there's a lot of times where I imagine they would be butting heads, and you can see it in the commentary coming from both APRA and the treasurer being like, we are wanting to do this, and they are opposing forces. So I imagine and I hope that APRA will be pretty neutral, being like, no, we want to make sure this country doesn't collapse, that the banks don't collapse, that everyone can access their super, that we're not lending to, people that shouldn't be borrowing, that we're not putting the financial stability of a country at risk like they have in other countries, remember the GFC. So I think their job is super important and it shouldn't be dependent on what the government is doing, but it does make the government's job a bit harder when they're trying to counteract what they're doing. Yeah,
it seems to be a lot of conflicting and opposing forces, and to your point around what is a genuine driver of growth in areas that are generally driving because of economic fundamentals versus areas that are growing purely because of a focused buying regime of buyers agents. And I think pockets of Melbourne and wider Victoria certainly fall into that bracket. Like the economic fundamentals in Victoria right now don't support the growth that has taken place. And if you look at this SQM report that has come out, Sydney and Melbourne are quite subdued compared to other markets on their base case, right? And somewhere between sort of 3 and 5%. I'm plucking the number out. It's thereabouts. Whereas Perth, Brizzy, and Adelaide is continuing to have good solid runs, which have sort of different fundamentals which are driving those markets. The state governments need transactional activity to fill their coffers to support the spending that's taking place. From what I understand, a lot of lenders now, Annie, you could probably talk to this, are questioning the dynamics of the purchases in some of these locations, and they're actually asking how many buyers agents were bidding on particular properties when contracts getting done and valuations aren't stacking up already.
Valuations are always an ongoing issue.
They are stacking up in pockets, but primarily in Victoria, valuations aren't stacking up, and lenders are getting very jittery about it. And there's already certain places where they're going way overexposed with property investors. We're not lending there.
Yeah, and we do see that a lot. I mean, postcode limitations are an ongoing thing. It's normally because of things like flood fire risk, like uninsurable areas, or it might be for other things like factors such as, do we really think the values in this property area are actually true? But yeah, I think a lot of the time, I mean, so often, again, I was speaking to a broker recently for a podcast and they said the valuation came out between one lender and another at 150,000 difference. And I was a bit like, that is an unbelievable difference. And obviously they go for the one that has a much higher value so that they can put the client into a better sort of equity position. But it's just like, how is that possible? Like that it's 150K difference. And, it could be that they're doing a desktop val or they're doing a full val or they've got something else that they know about, like what data are they looking at? But that really is something that's a big problem, is, again, like the not knowing what you think your property is worth or the property that you're buying is worth, and then being shocked by it when you see it either positive or negative.
And CPI data that's coming out today.
It came out about half an hour ago,
Half an hour ago. What were the numbers, sorry?
3.8 is... the year to October, that's, hang on a second, annual 3.8. Let me see if I can find the underlying. Trimmed mean 3.3 in the 12 months, up 3.2% from the previous month's data.
So this is going to lend itself to probably steady she goes with interest rates for the moment and maybe an increase. Now, those CPI numbers would indicate that we're not looking down the barrel of interest rate cuts at any point.
Not any time. Not for next week at least. Which is the next
when's unemployment
decision.
rate come out next? That's normally a bit of a tell
For a while,
as well.
I think,
So what does all this mean for property investors, and what does it mean for those people who are financing investment properties, and then also for the real estate sector in terms of supply and demand and market activities? If you are a property investor and you've been in the market for some time, all of this pressure will be good for you, particularly the supply and demand equation, noting that where most property investors are operating is typically the areas where most people are operating with a 5% scheme. So if you're in that belt, there should be ongoing positive pressure around it. I think the 5% scheme is going to need to be rescinded at a point soon. And I'd say if I was advising government, I would get them to be reviewing and revising it. Maybe don't turn it off completely, but I'd be getting on top of it, and I'd be shaping and changing that rapidly, because we are manufacturing many, many problems for the future. Now, I'm a property investor and I've got lots of property, so, the prices keep going up. Isn't that great? But for those people who are looking to get into the market, whether as an investor or not, it's got to make it more and more challenging. Now, you look at the dynamics today, Annie, you have more people, inverted commas, rent vesting. So rather than going down a traditional point, and this is to Macquarie, they're saying we want to do traditional lending for Australians in homes. And I think CBA's probably has similar rhetoric to that. Fair enough. But if more people are buying an investment property first rather than an owner-occupier home, what's happening there? That means you get more renters because people aren't buying homes, and they're creating more investment properties for more people to rent. Again, there's seismic changes to the inherent way in which Australians live. And if you
that
only
would
need to go back,
artificially inflate the lending numbers.
it would do. Yeah, it would have to, right?
Yeah.
Because, if you've got more
values.
people renting, so you've got more people taking on investment properties rather than owner occupier. I think there's probably, I'm going to pull a number out, somewhere 3 to 5% of that lending should traditionally would have been owner occupier stuff.
Yep.
Because that's people buying a traditional Australian dream, that is a house in the suburbs.
They're not living in it.
Rather than they're not living in it. So I think what we're going to see is a seismic shift to the very nature of how Australians live. Pre-World War II, I think you go back to the 30s, and again, I'll probably butcher this number, but like half of people rented. It's a relatively new thing for Australia that you have more people owning their homes or debt against their homes than property investment. So, whether or not APRA can curb that and change that, whether Australian wants that, I don't know, Annie.
Yeah, well, we'll have to wait and see what happens with rates. And then, most of the economists saying no cuts until at least May. There was a couple of outliers. But I haven't seen reactions since CPI data came out, so they might be changing their tune. But most of them had all pretty much moved back saying, probably not till mid-2026. I think based on what we've been hearing from the RBA, they're in no rush. They have no reason to cut rates. People are still spending. There's, Black Friday sales are currently on, so we've got to wait for that data to see what is happening in the economy. What are people doing? People generally are still spending. Unemployment is still pretty low. And, people are still buying houses, so there's no immediate need for them to drop rates. The problem will be, what is causing inflation? Is it a lack of supply? And then how do we fix that?
And innovation in mortgages, if Macquarie is out of trust and company lending, and I'm sure there'll be outliers around it. It's not a big part of the market, and CBA, there'll be innovation elsewhere. There'll always be people for investors. Like I hold a lot of property in trust, but I don't do it for serviceability reasons. I do it for all the other reasons. So there will be a cohort of investors who collateral damage as a result of these decisions, but other lenders will feel the need.
Non-banks already, they were very quick. It's pretty much as soon as Macquarie announcement came out, they were all falling over themselves to be like, we'll do it. Lots of non-banks stepping up, as is traditional when the banks, the mainstreams, pull back.
So your message to property investors will be, make sure you speak to a mortgage broker.
Speak to a broker. I do not have any kind of advice for you. You need to go and seek qualified advice from a credit advisor.
Yeah, and buyer's agents are becoming a fundamental part of the landscape with property investors, rightfully.
And it's super useful skill, super useful profession, just making sure it's staying in their lane.
And this is the point. I don't think buyer's agents know what their lane is. It's because they've become like this, the sort of central advisor to property investors, rather than being an accountant or a financial planner. It's become a buyer's agent. Now, there's some very good buyer's agents out there who are very good with property investment strategy, but that's some, not all. And the biggest issue for Australians, if they're choosing buyer's agents, is make sure you're choosing the right one who's giving you the right advice, because it can be very expensive to unravel bad advice. And
we hear so many crazy stories over at REB of people that are getting double commission on both sides because they're in bed with developers. We hear stories of people that they're going to these hotspots, but they don't even bother going on the ground, and they're just getting agents to take the walkthrough videos of them, send them through. Now, if you're essentially colluding with the sales agent as the buyer's agent, you're definitely not getting the best price for your client. And what we've spoken about at length, Phil, not necessarily on this podcast, but just in our own conversations, is this addiction to this notion of off the market buying. There is a market price for stuff. Yeah, there is a market price where the vendor is either happy to or not happy to, and we get so caught up in this marketing terminology to try to hook in new clients, hook in new customers, and there are some real horror stories out there, and you've got to pick the right person for you.
Yeah, I don't want to get into this whole off market discussion right now.
Yeah, I know. I shouldn't have done it. I can see your
but what you pay for a property
blood pressure
is what the property's
rising
worth, right? And I'd say it would be highly likely that within a decade there'll be a royal commission in relation to property investment advice. And there's been people who have been trying to get it regulated for years, and it's very, very hard to regulate. Where does it sit? Is it fair trading? Is it ASIC, whatever? But the way it's heading and the way in which certain elements are propagating the value of a buyer's agent, it's not, hey, I'll find you off-market property. Most people sell property off-market if there's something wrong with it, or there's some situation. It's very, very infrequently you get a really good property off-market. Because why would a vendor sell a property cheaply?
Yeah, why would they lose money for themselves?
Why would they lose money? Normally, it's
unless they just don't want to do the advertising spend. But that's not that much, surely.
A couple of grand on Rio.
Well, this is the point for you, and I would certainly caution real estate sales agents around this, and from what I understand, this is happening. Buyers agents essentially have just become an arm of a sales agent, and this is, I'm speaking very simply because I'm a simple bloke and I've got to think about it this way. If I'm a real estate agent and I go, okay, I've won a listing, my job is to win listings, right? And then sell it for the maximum price. If I'm a real estate agent and I win a listing, I want to get paid my commission as quickly as possible. Simply. That's what they do. And I want to create value for the vendor. So what do? I'll just call up 10 buyers agents and go, hey, I've got this place, inverted commas, it's off market. I haven't listed it yet on realestate.com.au. Get me a contract by the end of the day and it's yours.
There have been some pretty well documented cases of buyer-seller collusion.
Yeah. But it even gets to a point now, and what I'm hearing is
agent collusion. Yeah,
agent. Where an agent will say to their favoured buyer's agent, "Hey, this thing's probably worth $600,000. That's what the market would be. However, I'm going to shop it out to these other buyer's agents who are all scrambling to find stuff. If they're going to pay $640, I'm going to give it to them. But if they don't go $640 and it sort of lands about $600, I'll give it to you."
Yeah.
So this is happening now.
Well, that's the risk. And I know we're going.
So
down
if you're
a bit
using
of
a buyer's
hole,
agent, and if you're using a buyer's agent who's just happy to get a deal signed at $640, you're paying $40,000 over.
We are getting down a bit of a rabbit hole, but this is the risk of that hotspot chasing, where people see a postcode and they put their blinders up, and the BAs spend so long driving in that this is the postcode you need to be in, that people end up overpaying. Yeah. We hear the stories all the time.
Yeah, and what happens then? Negative equity. Or the val doesn't stack up.
Yeah.
Or you actually get a lender to finance it at that, and you're in negative equity should you need to sell it, because you've got to sell it for less. You've dusted all your costs connected with it. So this is the reality of the market we operate within. So as property investors, you're responsible. You've got to make these calls. Surround yourself with the right people. Anyway, do you think they'll just tap the brakes, Annie, APRA, or do you think they're going to apply them pretty hard?
I I'm not sure. I feel like given that the whole market is hot, like every single segment of the market, SMSF, first home buyer, downsizers, bridging people who are wanting to invest, like every single part of the market is hot at the moment. So it's a great time to be a broker. But yeah, I think they might just tap it a little bit. I don't think, if they do come in, I think it will just be one of either 10 or 30% like they did last time. I don't think it will be crazy.
Yeah. There you go.
Who knows?
Well, for the listeners, if you're interested into the machinations of the industry that is behind property investment, mortgages and real estate, you can look at theadvisor.com.au or brokerdaily.com.au. It's that's for the broking sector, the mortgage sector, but interesting insights there, and real estate business if you're interested in the way in which agents operate. And we'd like to shout out to all of those professionals out there tuning into this. If any of this stuff resonated with you, if you know of these type of things happening in relation to the conduct between agents and buyers agents, and maybe some of the emerging relationships or the dynamics of those relationships, I'd really like to shine a light onto it, because as probably one of the few neutral, impartial platforms which looks at this without fear or favour or bias or an agenda, we want to make sure we're putting all this stuff to light so you can make more informed decisions, and that's what we're all about. So thanks, gang. Thanks for coming on, and maybe we can do more of this if you think it was good.
Well, that's your wrap for What's Making Headlines. Let us know if you enjoyed this kind of format and want to see more of it. You can pop some comments in below. Obviously, leave a review as well on the Advisor Podcast Network. Plus, send in anything else that you've been seeing. If you've been seeing any of the activity that we've been talking about here today, you can email us at editor@theadvisor.com.au. In the meantime, we hope you have a great weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.